A severe double miss on both the top and bottom lines for Matthews International, ticker MATW, for fiscal Q3 2026. Revenue came in at $246.02 million, which is down 29.6% year over year, missing the consensus estimate of $264.54 million by roughly 7%.
Yeah, and the bottom line is arguably worse. Diluted GAAP EPS swung to a loss of 75 cents, and then adjusted EPS came in at just 6 cents.
Wow.
Right? The street was looking for 41 cents, so that is a massive 85% miss.
Then obviously management slashed the guidance, right?
Oh, absolutely slash it. Full year fiscal 2026 adjusted EBITDA guidance was lowered to a range of $158 million to $162 million. Keep in mind, they had previously been reiterating a target of at least $180 million.
So they just completely pulled the rug out, and the market punished the stock immediately. Shares plunged nearly 13% in after-hours, trading down to $24.10, and then just kept sliding to around $23.41 intraday.
Yeah, a 15% plus drop.
Exactly, which triggered an immediate Zacks strong sell rating. You know, this earnings report really looks like a car that hit 3 different potholes on the way to the dealership. I mean, revenue, earnings, and guidance all blew a tire.
That is a great way to put it. And if we're looking at the deepest pothole, the one that really wrecked the suspension, we have to look at the industrial technology segment.
The anchor dragging the ship.
Exactly. Sales there plummeted 56.8% to $38.02 million. And they swung from a $9.04 million profit a year ago to an operating loss of $5.39 million.
Which is just a massive reversal. I mean, going from a solid profit to a $5 million loss in a single year.
Yeah.
How does a top line fall almost 57% that fast?
Well, part of it was a known variable. In Q1, they divested their warehouse automation business.
Right, so that revenue just vanishes from the year-over-year comps.
Exactly. The market expected that piece. But the unexpected damage, the real shock, came from severe project delays in their energy storage engineering business. Management specifically cited the direct impact of an ongoing dispute with Tesla.
Oof. I mean, pointing to an ongoing dispute with a client like Tesla as the reason your segment swung to a loss, that is a glaring customer concentration risk.
It's a huge red flag. But to understand why it hit so hard, you have to know what they're actually building for them. They are engineering equipment for dry electrode battery manufacturing.
Let's actually unpack that for a second, because dry electrode is this massive buzzword right now. In traditional EV battery manufacturing, they mix the materials into this wet, toxic slurry, right?
Yeah, and to dry it, you need these giant energy-intensive ovens that take up massive factory floor space. It is super inefficient.
Right. So the dry electrode method is the holy grail. You mix it as a dry powder and press it directly into a film using incredibly precise, high-pressure rollers. You skip the ovens entirely. And Matthews is building those rollers.
But here's the catch. Scaling that process without the film tearing is notoriously difficult.
Right. It's like trying to bake a cake with only dry ingredients and just hoping the pressure holds it all together.
Exactly. So when a giant client like Tesla hits a scaling snag and pauses the project, Matthews' revenue recognition just completely halts, but they still have to pay all their specialized engineers.
So the cash flow stops, but the fixed costs don't.
Precisely. And management's response is to initiate this European engineering restructuring program. They claim it'll yield $10 million in annual savings.
But wait, didn't they say it cost $10 million just to implement it?
Yep. They already took a $5 million hit this quarter just to get the ball rolling.
See, I have to push back on management's framing there. They're touting future cost savings, but when your segment revenue drops 57% and swings to a loss, is a restructuring program actually a fix? Or is it just putting a Band-Aid on a bullet wound?
It definitely feels like triage, but they aren't fully retreating. They're actually launching something called MATW, which is a next-gen dry electrode battery manufacturing demo line over in Germany.
Oh, wow. So they are doubling down on the tech.
They are. They clearly still believe they hold the winning ticket for the future of battery tech.
But holding that ticket is costing them a fortune right now. Which brings us to a big question. If the high-tech, growth-focused industrial segment is bleeding out, how is the core foundation, their death care business, holding up?
The memorialization segment, caskets, cemetery memorials.
The ultimate cash cow.
Right. And on the surface, sales actually grew 2.1% to $208.12 million.
But that's artificial, isn't it? That growth is just from them acquiring the Dodge company.
Exactly. If you look at it organically, volumes for caskets and memorials are actually down. Management specifically blamed lower estimated U.S. casketed deaths.
It is the one industry where good news for humanity is genuinely bad news for the bottom line.
It really is.
But jokes aside, I mean, If acquisitions are the only thing masking the organic volume declines, how sustainable is this cash cow? Because cremation rates are just going to keep rising.
And that's exactly the problem. Plus, they are facing severe margin compression. Despite the higher total sales, adjusted EBITDA for this segment fell to $42.2 million from $42.8 million.
Let me guess. Input costs.
Oh, completely. Escalating costs for materials and labor are completely outpacing whatever inflationary price increases they can push through.
Right, because the buyers are these massive consolidated funeral home networks. They have all the negotiating power. If Matthews tries to hike casket prices too much, the buyers just go somewhere else.
Exactly. So they have to eat the higher costs.
Okay, so wait. If the industrial segment is bleeding and the memorialization segment is seeing shrinking margins, how on earth did Matthews report a higher consolidated adjusted EBITDA margin?
Yeah, it went up to 14.2% from 12.8%.
Right. How is that mathematically possible when both your operating engines are sputtering?
It all comes down to accounting shifts and some balance sheet maneuvering with their third segment, Brand Solutions.
Ah, the SGK transaction.
Exactly. So Brand Solutions is now unconsolidated. It's operating as a joint venture called Propellus.
Okay, so let's break down why unconsolidated is the magic word here. By making it a JV, they wipe all that top-line revenue off their own income statement, right? The denominator shrinks.
Right. But because they have a 40% equity share, they still get to record roughly $10 million of Propellus's profit toward their adjusted EBITDA.
Wow. So it's just a denominator effect. You shrink the revenue base, but keep a chunk of the profit, and boom, your corporate margin percentage looks better on paper.
Exactly. It's an accounting illusion. And the catch is, the actual operations at Propellus are struggling. Management admitted that the anticipated synergies from merging the businesses are delayed.
Because integrating two different companies is always harder than the investment bankers say it will be.
Always. And because of that delay, they are forecasting a $5 million shortfall to their full-year expectations for the JV.
Okay, so the JV is underperforming operationally. Are there any actual bright spots on the balance sheet?
Well, the one major positive is debt reduction. They've been very aggressive here. They pulled in $25 million in cash just from redeeming preferred equity in that Propellus JV.
Oh, interesting.
Yeah, and they used that, along with operating cash, to pay down $12 million in debt in Q3 alone.
Bringing the year-to-date debt reduction to what, like $144 million?
Exactly. So net debt now stands at $529.7 million. And it gave them the cushion to maintain their quarterly dividend at 25.5 cents per share, which is about a 3.7% yield.
I mean, that's like selling the antique furniture to pay down the mortgage. You know,
That's a great analogy.
the house is less cluttered, the bank is happy, but your operating cash flow is still negative, and now you have nowhere to sit. They are shrinking the enterprise to service the debt.
They absolutely are. And that brings us to the real wild card here, the leadership shakeup.
All right, the timing on this is just wild. We've dissected the segment struggles and the debt paydown, but who is actually steering the ship through this?
Well, it's a changing of the guard. Longtime president and CEO Joseph C. Bartolacci announced his retirement on August 4th.
Which was exactly 2 days before this brutal earnings release.
Yep. Just 48 hours before they drop a massive double miss and slash guidance.
I have to ask, does a CEO announcing his retirement exactly 48 hours before a disastrous print signal a smooth planned transition, or is that a hasty exit before the storm makes landfall? The optics are just terrible.
The market certainly didn't like it. Now, they did try to throw in some positive news to soften the blow. They announced a strategic partnership with Lynx Printing Technologies to expand their consumer packaged goods reach in the UK and France.
Sure, but a regional printing partnership is a total footnote compared to the bleeding in battery tech and a sudden CEO departure.
Exactly.
So if you are looking at all this, it leaves you with a really broad strategic question. You know, Matthews is aggressively paying down debt, but they're banking their future growth on this incredibly complex, speculative dry electrode battery tech.
Meanwhile, their core, stable death care business is facing permanent demographic headwinds and margin compression.
Right. So the question is Matthews International slowly morphing from a reliable industrial conglomerate into a highly speculative tech play? Because the market clearly isn't pricing them for stability anymore. Definitely something to mull over as they transition leadership.
Absolutely.
All right, that covers the damage from the Matthews Q3 print. Make sure you follow the show for our daily earnings coverage so you can stay ahead of the markets and catch these deep dives as soon as the numbers drop. Catch you next time.